Alrighty. So in today's video, I'm going to be sharing with you 5 option strategies that are profitable over the long term. So guys, the key word here is the long term. Now, for this to have a long-term profitability, two things need to be aligned with each other. So the first one is your option strategies. Okay, so let me just write it here. Now, the second one is the underlying, right? Underlying is basically what it is, right? What is the underlying you're going to trade that basically aligns, that is cohesive with this option strategy that you're going to use. So these two need to actually align with each other, right? They are almost like a couple, right? Imagine, this is the husband, this is the wife, right? They both need to get along well for the relationship to work. But if they start to quarrel, then guess what? There's going to be a breakup, there's going to be a divorce. Well, some of you, maybe it's just boyfriend and girlfriend, right? Things are not going to go well, right? Then things are not going to go well. Then, well, in terms of option strategy, that's where you're going to, lose money. So it's very important that when we are choosing this option strategy, it has to align with the underlying that we're going to choose. The characteristics of the underlying has to suit this option strategy. So for the most part, these strategies that I'm going to share with you, we're going to trade a very, very specific type of underlying. And this specific type of underlying, if you guys have been following my channel for quite some time now, you guys probably already know. And that is to trade the index ETFs, right? So the index ETFs, not any index ETFs, we want the US broad-based ones, the very, very popular ones, like for example, IWM, SPY, QQQ, so on and so forth. Now, one thing to understand is what is the characteristic of these underlyings that we're choosing, right? This characteristic of the underlying, one thing you need to understand that it is called positive drift, right? Positive drift. Positive drift just means that over time, the market wants to keep going higher. So just take a look at the chart right now, right? Just take a look at all the different index ETFs, the broad-based ones. Look at it 10 years ago, 20 years ago. You will see that the price just is much, much lower, right? Compared to now, the price has just kept making new highs over the years. So that is why we want to use our strategies that is, aligned with this characteristic, this positive drift characteristic. So for the most part, we are going to be using either bullish or neutral to bullish kinds of strategies. Now, you might be wondering, Davis, what about individual stocks? So what I would say is that if you are just starting out, I would suggest index ETFs first because they are less volatile and we already know what is the characteristic of this, right? It's predictable in the long term. We know the market just wants to keep going up. So we just need to pick our places when we are trading this options strategy. But if you were to trade individual stocks, it can get a little bit tricky because stocks cannot keep going up in the long term, right? Certain stocks, if you choose the wrong stocks, let's say, for example, you start to trade those meme stocks like AMC, GameStop, all these stocks may not necessarily fit well with these option strategies that we are going to choose. Now, some people might say that, hey, the individual stocks have much higher volatility, right? Higher volatility, so I can get much richer premium. I can make more quickly. So yes, that is true. But again, what is the point of higher volatility, higher premium if you can't actually keep it, right? That means you lose when you start to trade the strategy. So for me, I'd rather be more content with a lower volatility, but I know that in the long term, I have the edge. That in the long term, my account at least is going to grow. All right. Okay. So now that we've already decided on the underlying, let us get into the option strategies, right? So what are the option strategies? So the very first one, so let me just first delete all this drawing. So the very first one is the most bullish of all the 5 strategies I'm going to share with you. And that is none other than the classic vanilla short put, right? So the short put is the most directional one of all the strategies because, we generally want the market to go up when we put it on, right? So the short put on the index ETFs has been, studied a lot of research as well, and in my own experience as well. Overall, in the long term, it's a profit, right? It's profitable because it makes sense. Market keeps going up. The strategy we use is a bullish one. So for this, how are we going to select our strike price? Now, there is actually a range of strike prices you want to choose, but generally, for me personally, when I choose this short put strike, I take a look at the delta, right? So the delta basically just depicts what is the probability of, the strike being in the money expiration. It also depicts basically the probability of win, right? So if you take a look at the delta down here, you can see there's 0.14 all the way to 0.45. So if you were to just go to the one right at the money, so this one down here is what we call at the money, because the current market price is somewhere around 203.5, right? As you can see over here. So this is where it's at the money, where you get the highest premium. You get the highest premium, but the trade-off is that there is a higher chance for this strike to actually be in the money at expiration, which means to say that chance for you to lose money. So the probability of win is basically just 100% minus of this, right? So if you see 45 delta, 0.45, it just means there is an estimate of around 45% chance that this strike 203 will be in the money at expiration, right? So if you just take 100% minus 45%, it means the win rate is roughly around 55%. Now, on the other end, you have one that is 0.14. Now, by the way, this is not the lowest delta, right? As you can see, there are many, right? So based on 0.14, oops, let me just remove this drawing again. So let's just go with, let's just go with the 10 delta, because quite a lot of people like to, choose the delta that is very far away from the market because they don't want to get hit, right? So as you can see down here, 10 delta means that you have a estimate of roughly 90% win rate. So it's very high win rate. Many people like that. But the trade-off is that you're going to get, pretty low premium for that, right? At least you see if you compare it to the one that is at the market. Let me just go all the way down again. You can see it's roughly $5.34. So that's quite a big difference. So we want a very good balance between, premium as well as the probability of win. So that is why generally when it comes to the short put strategy, I will go for somewhere around 20 to 30 deltas. That means to say you have a rough win rate of around 70 to 80% based on, the theoretical pricing of the options. So basically you can choose any of this strike price down here, right? So if you want to go for the one at 30 deltas, all you got to do, just click on this, and this is the premium that you're going to get, right? So down here, it says the premium is $3.13, which means to say per contract, you actually receive $313 in terms of credit because each option controls 100 shares. So this is the first strategy called the short put. Now, let's go to something that is a little bit more neutral. So neutral strategies are also what I tend to put because the market doesn't go up all the time non-stop, right? So although it's positive drift, right, the market goes higher over time. Let me just get my marker. So the market just wants to go higher over time. But there are times where, the market can just pretty much stay still, right? There are times where the market can just go something like this for a while before it goes up, right? So this period of time, using neutral strategies can be actually pretty good as well. Especially we already know that, using the DTE that is more than 45 days, more than 45 DTE, we know that the realized move is most often time lesser than the expected move. So that's our edge when we're trading neutral strategies. So what is this neutral strategy? So for me personally, I like to trade the strangle. So the strangle basically is just a short put and a short call combined. Now, if you are new to trading options, this is definitely not something you want to get into right at the start, but I'm just sharing with you the strategies that I personally use. So the short strangle, the way that I trade it, generally, I trade the expected move. So what is the expected move? So the expected move generally means it's around 16 delta. So we choose the short strikes around 16 deltas, right? So 16 delta, so we will go for somewhere around here. So you have 189 and you go all the way to the other side, which is the call side, and you go for the 16 delta, right? 16 delta, let's go a little bit more downwards. All right, so we can see this is 16 delta down here. So I will go with this. So as you can see down here, this is the strangle. So slightly different strategy from the short put, because the short put slightly more bullish. Strangle, we want the market to pretty much just bounce back and forth within our range down here, right? Within this strangle strikes. Now, for those of you who have a smaller account, you're not able to trade the strangle, then you can go for the defined risk version of the strangle, which is essentially called the Iron Condor, right? The Iron Condor just basically is similar to this, right? You have the two short strikes. Now, all you got to do is to buy the long wings, right? So for example, you buy the long wings down here, and on the other end, you buy the long wings as well. So let us go for the same equivalent width down here. So down here is 4 points wide. So the other side, we also want to build one that is 4 points wide. So that will be roughly 185. So this way you have a very even Iron Condor construct. Now that is not to say that you must go for 4 points wide or how many points wide, right? Ultimately, this comes down to your own risk tolerance, right? So two ways to do this. If you're the type that likes to have, a fixed width every time, then you can go for a fixed, $5 width, and based on your, risk allocation, maybe you have to increase the contract to fit your risk. Now, the other way would be to just expand the wings to fit your risk allocation. So maybe if your risk allocation is somewhere around maybe close to $1,000, then you want to go 10 points wide. 189, you go 10 points wide, will be 179. And on the other end, same thing, go 10 points wide. Now, if you do not have any 10 points wide down here, then you got to start to make a decision, right? So maybe you just go for 9 points wide down here. And on the other end, you adjust, or you can just leave it as well as a skewed Iron Condor. Okay, so back to the strangle. So what I want to share with you is that the strangle also has been, thoroughly studied, thoroughly tested by the Tasty Trade team. There's a lot of research on their site. You can just go there and find out, and you can see that over the long term, the strangle also has a positive expectancy, right? It's net profitable over the long term, over many years, right? So again, when we are putting on any of these strategies, look out for the next 100 or more trades rather than the next, 5 to 10 trades, because 5 to 10 trades, you can still be in a loss. Now let's get into the third strategy. So for the first strategy, we have a bullish strategy. Second one, we have a neutral strategy. Now the third, fourth, and fifth, this is where we're going to go for omnidirectional strategies. So omnidirectional strategies are also one of my favorite strategies to trade because it is pretty versatile and it gives you a little form of insurance, right? So let me just show you what I mean. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So the very third strategy, which is the first of the omnidirectional strategies I'm going to share with you, is what's called the Jade Lizard, right? So the Jade Lizard is pretty much a combination of 2 strategies, right? The very first strategy, we have the short put. So we have already talked about the short put, the very first strategy. So the Jade Lizard consists of a short put. So for this, I'm just going to choose the expected move, which is 16 delta. And then on the other side, you have a call spread, right? You have a call spread, which is a bear call spread. So for the bear call spread, you can choose somewhere around 32, 35 deltas, somewhere around here, right? So let's say we go for the one around 36 deltas, 211, and then let's go for the 212 strike. So you might be wondering, why is there a call spread, right? So the call spread down here is to add additional credit to your overall strategy, because if you were to just take a look at the short put down here, you may only get $1.47. But if you were to add this call credit spread down here, you can get an additional credit, right? So overall, you get more premium than just selling the short put alone. So also, this shows that there is a delta of around 36 deltas, which means to say, not all the time the market will actually go above this strike price. There are times, right, where the market will actually stay below 211 and above this short strike down here. And this is where your maximum profit is going to be. So as you can see down here, this serves as a little form of a hedge in case the market comes down, right? Or if the market doesn't actually go up that much. So this can actually help you in case, let's say, the market goes a little bit much closer to where your short strike is. Hey, at least you have a form of a mini hedge the call credit spread is making some profit over there. So straight away, when we take a look at this structure, the first thing you want to see is that your credit is actually more than this credit spread down here. This call credit spread has a $1 width. That means to say the max loss for this call credit width is $1. So your premium, you want it to be more than $1. And what's the reason for that? The reason is because we do not want any risk to the upside, right? That means to say if the market goes all the way up, you still can get a profit. So how you know that is simply by taking a look at this premium down here. It has to be more than the call width down here. Now, if you want to be sure whether there is no risk to the upside, then this is where you want to go to the P&L graph. So as you can see, this is the P&L graph of the Jade Lizard, right? As you can see, our call credit spread is on the right hand side down here. This is currently where the market price is. This is where the market price. And then on the left hand side, this is where our short put is. So as you can see, this forms a structure that where you have a max profit zone somewhere in the middle. And as you can see, even though if the market continues to go up to the right hand side, that's where, the market starts to go higher, there is no risk to the upside, right? So this is a pretty good strategy that I like to use as well. It's called the Jade Lizard. So if you're not too bullish, you're thinking that, hey, maybe the market has a chance to go down a little bit, then this Jade Lizard can be pretty good. And this Jade Lizard is actually pretty flexible in its construction. So for example, if you want it to be a little bit more defensive, that means you want to get more profits inside this max profit zone, what you can do is widen out this call credit spread. So for example, let me just shift one more point out, and you can see over here, we just managed to make it a $2.10 credit on a $2 width, which means to say there is still no risk to the upside. And on the upside, let's say for example, the market goes past the call credit spread, you at least still have, $10. Not a lot, but hey, if the market stays within this profit zone, then you're going to make a little bit more. And that, as you can see over here, is $210 compared to previously is around $180, I think. $180 on the right hand side is $80. And then over here, if I change to 213, it's slightly more, 210, and on the upside is $10. So this really is up to you to design, a construct that you like and you feel comfortable with. All right, so now let's get into the fourth strategy. Also another omnidirectional strategy, and another strategy I really like a lot. It's what's called the wide put ratio spread, or rather it's a term that I coined it myself because there isn't exactly, a formal name for this strategy. I call it the wide put ratio spread, mainly because it resembles a put ratio spread, but the strikes are slightly apart from each other. So here's what I mean. So first thing, again, we want to construct where our short put is. So it's a combination of two strategies. The very first one again is a short put, and then on the other end, right now this time we're going to still stick to the put option, right? We're going to stick to the put option, and this time we're going to use this credit that we receive, $1.48, and we're going to use part of it to buy a put debit spread. So the put debit spread, we want to buy somewhere around at the market. So maybe we go for this one, and let's see how wide we can go. Let's see if we go for 2 points wide, we are able to still get a credit, right? So with this, we have 62 cents credit. If we remove this put debit spread, we have roughly about $1.50. So means to say we use roughly about half to purchase this put debit spread. So this put debit spread serves as a form of an insurance as well, right? So you notice it's something similar to the Jade Lizard, but the difference here is that with this put debit spread, we actually have slightly more protection and more credit upfront, because the max profit zone is not going to be as wide, right? So let's get into the P&L graph again. So as you can see, this is the P&L graph for what I call the wide put ratio spread. Now, previously, we have the Jade Lizard, whereby the construct was stretched out slightly further down here. Now, if you recall for the call credit spread, when we constructed this 2 points wide credit spread, we only get about $10 on the upside, right? Although we get a much, bigger profit zone. Now for this wide put ratio spread, although you have a slightly smaller max profit zone, but the minimum profit you can get once the market goes past this point down here, you can get roughly about 62 cents, which is $62 per construct. So as you can see, this is a trade-off. And I like to put this on when I'm a little bit more defensive, right? So most likely the market has gone up a little bit and I want to be a little bit more defensive rather than go with the Jade Lizard. So this is where I will put on the wide put ratio spread. As you can see, they are pretty similar to each other, but the wide put ratio spread gives you a little bit more defense because as you can see down here, when the market comes down, you can get about $262. Now, if you want to get a little bit more defensive, you can actually stretch this to maybe one more point wide. So let us try that. So for this, we need to buy the debit spread that is 3 points wide instead of 2 points wide. So let us change the strike down here to 200 and see what we can get. All right, so as you can see, let me just remove this drawing. We can actually now get $324 if the market actually settles below where the current market price is, right? You can see down here, if the market goes down, settles somewhere within this max profit zone, we get much more than the Jade Lizard, right? The Jade Lizard is somewhere around 210 at the most. This is 324. And if the market goes up, hey, at least we still get $24. So this is the wide put ratio spread. All right, so let's go to our fifth and final option strategy. Another option strategy that I really like to put on a lot, and that is the put ratio spread. So previously we talked about the wide put ratio spread. Now let's talk about the actual one, the put ratio spread. So again, how it starts off with is pretty much we just want to select the short put strike. So the short put strike around the expected move, right? This can be 16 to 20 deltas. So let's say, for example, let's stay consistent. Let's go with the 16 delta. Now, once you have already found the short put, again, we're going to use this credit to buy a put debit spread, right? But the difference right now is that the put debit spread is no longer going to be at the money down here, but rather we're going to share the same short strike as this 189 short put down here. So that means now I need to change this to 2. So we've already gotten the short leg of the put debit spread, the embedded put debit spread. Now we need to find the long leg. So we want to find the long leg. All we got to do is just experiment with the strikes to see how far we can get. So let's go for around maybe 5 point wide first. So for this, I'm going to change this to 1 because mainly that's how this platform works. This is the Thinkorswim web platform. If you use the desktop platform, you won't have this issue, right? So for this, basically, you can see that if I construct it this way, I still get a 59 cents credit. And now you notice my put debit spread is actually pretty wide compared to the wide put ratio spread. So the wide put ratio spread, it gets this name because it has a much wider max profit zone compared to the put ratio spread. So this is the put ratio spread. So you notice that it has this tent-like structure down here. So I call this the tent. This is pretty much where the max profit zone is, where, you know, as it settles somewhere inside this tent, you can get, you know, quite a pretty good profit. So the difference between this and the wide put ratio spread is the profit zone. So the profit zone of the wide put ratio spread, you will notice is going to be slightly wider. However, the max profit is lower. Now for this put ratio spread, you have an opportunity to actually make much more, right? So if you were to take a look at the highest point, the pinnacle of this tent down here, you can see you can actually get up to over $500. Whereas for the wide put ratio spread, maybe somewhere around $300. So this is just a trade-off, but both strategies, I still like them a lot. And the put ratio spread, I really use it as something very defensive. That means to say, if the market was to go up from where the current market price is, although I don't make that much on the put ratio spread, but hey, my overall portfolio is still going to go up, right? And then if the market comes down, I have this put ratio spread to potentially capture any move on the downside, right? So if it comes down, hopefully there's a put ratio spread, it goes inside the max profit zone, then that's where I can have, you know, some sort of a profit from the market moving down rather than, you know, I have nothing at all. Right, so that is why I also like the put ratio spread a lot. So these are the 5 winning option strategies that have been doing pretty well for me. So consider using it, and I hope it does well for you as well. And if you like this video, I greatly appreciate if you give me a thumbs up. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.